When diving into a company's income statement, the first thing to understand is its purpose. It's essentially a financial report that shows how much money a company made and spent over a specific period. Think of it as a report card for a business, revealing its profitability and operational efficiency. Let's break it down. The income statement starts with revenue, often referred to as the top line. This is the total amount of money generated from sales before any expenses are deducted. It's crucial to look at this figure closely. Is it growing? Is it consistent? A rising revenue trend can indicate a healthy business, while stagnation or decline might raise some red flags. Next, we move on to the cost of goods sold, or COGS. This represents the direct costs attributable to the production of the goods sold by the company. Subtracting COGS from revenue gives us the gross profit. This is a key metric. It tells us how efficiently a company is producing its goods. A high gross profit margin indicates that a company is managing its production costs well. Now, let's talk about operating expenses. These are the costs required to run the business that aren't directly tied to production, like salaries, rent, and marketing. When you subtract operating expenses from gross profit, you arrive at operating income. This figure gives insight into how well the company is managing its core business operations. A company with high operating income is typically more efficient and can weather economic downturns better. Don't forget to look at non-operating income and expenses, which include things like interest and investments. These can significantly impact the bottom line. For instance, if a company has substantial interest expenses, it could be a warning sign about its debt levels. Finally, we arrive at net income, or the bottom line. This is the profit after all expenses, taxes, and costs have been deducted from revenue. A positive net income indicates profitability, while a negative number suggests losses. But don't just take this figure at face value. It's essential to consider the context. Is the company reinvesting its profits for growth? Is it paying down debt? Analyzing trends over multiple periods can provide deeper insights. Is net income increasing year over year? Are margins improving? These trends can signal whether a company is on a solid growth trajectory or if it's facing challenges. Another important aspect is comparing these figures to industry benchmarks. How does this company stack up against its competitors? Are they leading the pack or are they lagging behind? Lastly, always consider the notes accompanying the income statement. They often contain crucial information about accounting policies, revenue recognition, and other details that can significantly affect your analysis. In summary, analyzing a company's income statement is about more than just numbers. It's about understanding the story behind those numbers, the company's operational efficiency, and its potential for future growth. By digging into these details, you can make more informed decisions about the business's financial health and its prospects.